Hello and welcome to Hungry for Moat. I got my friend Prabhat and myself Avinash, and today we're going to be continuing our journey through the Buffett Partnership Letters. We're at 19. Can you remind me the year?
We are in 1964, I believe, or maybe
1960,
63. Maybe
63.
1963, the
Okay.
latter half. You just finished.
Okay, nice. So 1963, and we didn't cover the appendix last time, so we'll go over the appendix. Hopefully, we'll get something juicy there, and then continue on. Okay,
All right.
okay. Texas National Petroleum. This situation was a run-of-the-mill workout, arising from the number one source of workouts in recent years: the sellouts of oil and gas-producing companies. TNP was a relatively small producer with which I had been vaguely familiar for years. Early in 1962, I heard rumors regarding a sellout of Union Oil of California. I never act on such information, but in this case it was correct, and substantially more money would have been made if we had gone in at the rumor stage rather than the announced stage. However, that's somebody else's business, not mine. In early April 1962, the general terms of the deal were announced. The TNP had three classes of securities outstanding. The first is 6.5 debentures callable at 104 and a quarter, which would bear interest until the sale transpired and at the time would be called. There was $6.5 million outstanding, of which we purchased 264,000 principal amount before the sale closed. Second is about 3.7 million shares of common stock, of which the officers and directors owned about 40%. The proxy statement estimated that the proceeds from the liquidation would produce 7.42 per share. We purchased 64,035 shares during the 6 months or so between announcing and closing. Third point, 650,000 warrants were purchased common stock at $3.50 per share. Using the proxy statement estimated using the proxy statement estimate of $7.42 for the workout, and the common resulted in 3.92 as a workout on the warrants. We were able to buy 83,200 warrants, or about 13% of the entire issue in 6 months. So just so that I understand correctly, so Buffett had advised us previously that we should not, if you go up just a little bit, so so he advised us that we should not invest in companies before we know the real news that's in the newspaper. So especially when it comes to workouts. So no really dealing with rumors. But in this case, I think he made an exception.
No, no,
And
no, no. He
oh, he
said
didn't make an exception.
I would have, if I act on a rumor, I would have made a lot more money, but I don't do that. If
Yeah.
you want
Okay.
someone to act on rumors, find somebody else.
Oh, okay, okay. That's someone else's business, not mine. Okay,
Yeah.
gotcha. So then he still made a killing off of this. So really, I think maybe just to recap, a workout would just be an investment where you know that there's about to be a spin-off, or there's, Joel Greenblatt's type of theory where something from an original company is going to get thrown away to a new entity, and usually they have backing from the parent company, and they should do pretty well. And I guess Buffett is saying that there was a $3.92 gain on each stock. Is that right?
Yep.
Okay. Okay.
Wait, what did you say last point?
$3.92 as the profit for.
On the warrants. He tells you about he does three kind of investing in this venture.
Mm-hmm.
Like they're selling to this new Union Oil of California or whatever.
Mm-hmm.
This new company is going to be merging with.
Mm-hmm.
So first he buys debt, then he buys stock, and then he buys options. He buys three different things.
Okay.
So the debt, I think what the first point is saying is I think he buys this maybe some 6.5 of the debt,
Mm-hmm.
callable at 104 and a quarter, which would bear interest. I think it's like a preferred stock.
Okay.
That's what it is. I think it's like a stock, but with like bond-like features, where
Mm.
you earned interest until the sale transpired, and the time would be called. where it turns into ordinary shares.
Okay.
And they had about $6.5 million of these kind of callable debentures. We might have to Google, maybe it's out the old term. Of he purchased basically $264,000 worth. So that's not. I mean, that's a pretty significant. I think he has $17 million in his um,
Portfolio. Or
portfolio.
as cash. Okay.
Or yeah, I mean of equity and cash. So that's I guess this is a small portion, that 264,000, and and about 3.7 million shares of common stock with a lot of insider ownership, 40%. And the proxy statement estimated the proceeds from the liquidation would produce. So they give you guidance, right? They tell you to disclose things, and they're saying with the liquidation of this sellout, they would produce about $7.50 per share. That would be the short-term profit from the liquidation from the company that's selling
Okay.
this oil company.
Okay.
And they're about 3.7 million shares. They're about 64,000. They bought a little bit.
Okay. So what did he? What? So the book value 7.42. Is that correct?
No, I mean it's only the things that they're selling as
Oh,
part
okay.
of this merger. I mean, it says, one person. Yeah, it's one way to think about it is, as part of this deal, there will be immediately this much uh, profit would be created. Maybe they're selling parts of the things to third business, or I don't know exactly, or the major company you're owning, they're selling this company to this third party, this Union Oil of California, and they're going to give cash, and that liquidation event is going to create this much extra cash that will be ultimately possibly given back to shareholders as a big dividend, maybe, for example.
Okay. Okay.
And
Interesting.
thirdly, they buy these long-term options to purchase the stock at $3.50. They buy, and then and using the proxy, using what the government's telling you, what the company's telling you, they think the stock would actually be worth $7.42. So they're buying a right to purchase the stock at $3.50, and they think the stock would be worth $7 and more than $7, resulting in, for every option there, they're basically getting almost $4
All about
as a
double.
workout on the warrant. I mean,
Okay.
they no, the money they're putting is, they're not even putting the $3.50. I don't know how much a warrant costs. Let's say a warrant costs about 20 cents to buy. All you're buying is a right to
Okay.
buy the stock at $3.50, and you can go and turn on the same day. You can sell it for $7.52, 42 cents.
Oh
So you
wow.
see, you
Okay.
can buy a right to buy something at a low price and then sell it at a market price, which is presumably higher. So that's what a call option is. That's what Elon Musk just dumped a lot of the stock. I think he just exercised his call options, where he had options where he could buy Tesla stock for, let's say, $50 a piece, and then he sold it for, like, $1,000.
Oh okay. Oh
So that
interesting.
that so that that's how you warrants are just, you know call options given by the company itself, that they're not going to the market, but the company is giving you a call option. That's a warrant. And they tend to be
Oh
long.
interesting.
So,
Okay. And this is done before the workout has happened, or is this?
yeah, this is just with the
Okay.
announcement, and then
Okay.
he buys 13. So this is where bulk of his money is.
Okay.
He bought 13% of all of the warrants. So this is
Yep.
what he's trying to. This is where most of his
Gotcha.
activity is going, I think.
Okay. Okay. Very interesting. Gotcha.
Okay, continue. The
The
risk.
risk, oh, you
Yeah.
want to, okay,
No, go,
sure.
go, go.
The risk of shareholder disapproval was nil. The deal was negotiated by the controlling stakeholders, and the price was a good one. Any traction such as this is subject to title searches, legal options, etc. But the risk could be appraised at virtually nil. There were no antitrust problems. This absence of legal or antitrust problems is not always the case by any means. The only fly in the ornament was the obtaining of the necessary tax ruling. Union Oil was using a standard ABC production payment method of financing. The University of California, Southern California, was the production payment holder, and there was some delay because of their emissary status. Okay, interesting. I don't know what that word means. This posed a new problem for the Internal Revenue Service, but we understood USC was willing to waive this status, which still left them with a satisfactory profit after they borrowed all the money from the bank. While getting this ironed out created delay, it did not threaten the deal. When we talked about the company on April 23rd and 24th, their estimate was that the closing would take place in August or September. The proxy material was mailed May 9th and stated the sale will be consummated during the summer of 1962, and that within a few months, thereafter, the greater part of the proceeds will be distributed to stockholders in liquidation. Okay, I don't know if I completely understood that.
We'll go over it.
Okay, as mentioned earlier, the estimate was $7.42 per share. Bill Scott attended the stockholders meeting in Houston on May 29th, where it was stated that they still expected to close on September 1st. Okay.
When is this written? It doesn't say here. Okay, doesn't matter. Okay.
The following are excerpts from some of the telephone conversations we had from the company officials in the insuring months. On June 18th, so he's talking about the process of buying these shares, right?
The conversations they have had with the management.
Okay. On June 18th, the secretary stated, Union has been told a favorable IRS ruling has been formulated, but must be passed on by additional IRS people, still hoping for a ruling in July. On July 24th, the president said that he's expecting the IRS ruling early next week. On August 13th, the Treasury informed us that TNP, Union Oil, and USC people were all in Washington attempting to thrash out a ruling. On September 18th, the Treasurer informed us, no news, although the IRS says the ruling could be ready by next week. Okay, so they're really delaying it here. The estimate on payout was still $7.42. The ruling was received in late September, and the sale closed October 31st. Our bonds were called November 13th. We converted our warrants to common stock shortly thereafter and received payments on the common of $3.50. December 14th, 1962, $3.90, February 4th, 1963, and 15 cents on April 24th, 1963. We will probably get another 4 cents in a year or two. On 147,265 shares after excess of warrants, or after the exercise of warrants, even 4 cents per share is meaningful. Okay, that's interesting. So he's saying $3.50 to $3.90, so at least we'll get 4 cents on all those stocks. Okay, or 40 cents rather. This illustrates the usual pattern. 1, the deals take longer than originally projected. And 2, the payouts tend, on average, a little better than estimates. With TNP, it looks a couple of extra months, and it took a couple of extra months, and we received a couple of extra percentage. Okay. The financial returns of TNP were as follows. On the bonds, we invested $260,773 and had an average holding period of slightly under 5 months. We received 6.5% interest on our money and realized capital gains of $14,446. This works out at an average overall rate of return approximately 20% per annum. Okay, wow, that's already good, right? I mean, 20% on your return.
Yep.
On the stock and warrants, we realized capital gains of $89,304, and we have stubs presently valued at $2,964 from an investment of $146,000 in April. Our holdings ran to $731,000 in October. Based on the time the money was employed, the rates of return would be about 22% per annum. Wow. So he's getting 20% from bonds, 22% from stocks and warrants. So he's already covered there. Okay.
But I think, and he held the stocks for longer. I mean, he went from 146,000 in April
Yeah.
to 731,000 in October.
Yeah. That's insane.
I mean, that like he tripled his money in October. Then he kind of stayed around to collect this extra four cents.
That's incredible. Okay. Actually, there was the average too. Can you go back? Just okay. 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 Yeah, I didn't miss that. So in both cases, the return is computed on an all equity investment. I definitely feel some borrowed money is warranted against a portfolio of workouts, but feel it is very dangerous practice against generals. Okay. So wait, did I read that correctly? That he's saying invest with borrowed money for
For
workouts?
workouts, just because they're predictable.
Okay.
And journals are not predictable.
But not all warrants are predictable. I mean,
But
not all workouts are
for
predictable.
him, they are predictable.
Okay. Makes sense.
He doesn't invest if they're not predictable.
Yep, makes sense. Okay, we're not presenting TNP of any earth-shattering triumph. We have had workouts which were much better and some which were poorer. It is typical of our bread and butter type of operation. We attempt to obtain all facts possible, continue to keep abreast of developments, and evaluate all of this in terms of our experience. We certainly don't go into all the deals that come along. There is considerably variation in their attractiveness. When a workout falls through, the result market value shrink is substantial. Therefore, you cannot afford many errors, although we fully realize we're going to have them occasionally. Interesting. Can we pause here for a sec? Because I'm interested in knowing. So whenever he says workouts, he's really done his due diligence, obviously. But then doesn't this kind of remind you of a SPAC deal in today's terms?
I mean, that is definitely a type of a merger. I mean, that would fall into this. SPAC is a merger.
Yeah.
But
So,
I mean, sure, I mean, there's a good deal, but usually SPACs tend to be done to raise money, not to get rid of, right? A SPAC is a tool. It's a special type of merger between a company and an investment vehicle just to fund that company. That's all it does.
to invest in that company.
So it tends to be these people are trying to raise money. That tends to be the reason for a SPAC. Someone needs to go public quickly and raise a lot of money. They're running out of cash. So, I mean, it tends to be SPAC companies don't make a good investment. At least that's what Munger would say. There may be some exceptions to that, I guess.
Okay.
But so here, yeah, workouts are about one company. Good workouts are one company's trying to sell off a bad part they don't want, and then selling it to somebody, and there, if you look into the details, you can find something attractive. Just because maybe it's $1 billion company spinning off a small wing that's like 20 million, they don't really care about. Just like drop in the bucket for them, but a small investor can get in there and make really good returns.
Yep.
But it benefits from forced selling pressures. A company splits into two. Investors end up with a second stock, like eBay and PayPal turn into two companies. eBay stockholders, I'm gonna get a PayPal stock as well. Maybe they didn't want to own PayPal, so they would have sold it. There would have been this kind of a selling pressure causing a decline in the stock, and it would create a good buying opportunity for someone who's astute and wanting to look into it and buy it. That's just an example.
Yeah.
So that's where Greenblatt would say, these kind of special situation workouts create a predictable opportunity. Here, I don't know what the details were, but sounding like management was very excited about this, and they continue to own 40% of this company while going through this sellout, knowing that there will be a big jump in stock price. And they have to make this public, and if you're following along, you can get in there and make a boatload of money.
Okay, and in today's terms, where do you get this information before they get spun off about the particular company?
So whenever they renounce it, I think they file that S1 or some form with the SEC.
Okay.
I don't know what it's called off the top of my head,
Yeah,
but
I
that's
remember
where the official
the.
announcements
Okay.
are, is when they do the filing and it shows up there.
Okay, but it shows the books of the company that's going to get spun out.
I
Is that
mean,
right?
about the whole deal. This company is selling this to this company, and then a journalist picks it up and makes a news article out of it, and that's how most people hear about it.
Oh, okay. Okay. Gotcha. Okay. Interesting. Okay. This was cool, and also a kind of good lesson here is that the amount of due diligence that Buffett did here. He had one of his guys go to Houston, really sit in on the
Is it Bill Scott?
calls.
That's the same guy of the Dempster guy, the
Bill.
CEO. He
Yeah.
like so basically, I mean, he does this. He finds out this is going to be a good thing for the shareholder, and then he buys the bonds, then he buys the stocks, and he buys tons of warrants.
Yep.
And he realizes there's really no risk because this is
Yeah.
a small enough company where there's not going to be antitrust issues,
Yeah.
and there's not going to be, investors saying we don't want this because most of the shares are owned by management. So I guess those are the big risks, right? Risk for merger or a special interest to fall is government intervention or investor intervention. But sounds like those were really not the case. The only situation was financing. Looks like this University of Southern California was gonna be the third person gonna act like gonna help with financing, or they're gonna, I don't really understand this, but they're going to borrow money from the bank using USC, and then
Go through
letting the
with
money
that
flow
deal.
through them for some
Yeah.
reason, and
Yeah.
IRS needed to be involved for this, and that caused the most of the delays and uncertainty of time. But it
Gotcha.
looks like they weren't that much delayed, maybe delayed by a month or two. The payout was a little bit better.
Interesting.
So
Okay.
they exercised their shares and bought them for 350.
Yep.
And then I think they got a payment of 390,
Yeah.
and then they got a payment of 15 cents per share additionally, and they had this many shares.
Okay. Yeah. Interesting. Okay. Got it. Okay. Let's keep going. So in both
And he's
Dempster
saying
Mill,
this is
right?
typical. So they're saying this is
Yeah.
just an average type deal, and this is kind of what you should be looking
Yep.
at if you're interested in this. So,
Yep.
so that's kind of a good template coming
Yeah.
straight from the goat.
Yep. Dempster Mill. This is going to be interesting.
Hmm.
MFG. Okay.
I think manufacturing company. I don't know what
Manufacturing.
it is. I'll,
Okay.
I'll read this one.
Okay.
This issue started as a general in 1956. At the time, the stock was selling at $18 with about $72 in book value, of which about 50%, $50 per share was in current asset. And we remember this. It was selling at 18, and it had a lot of stock holding.
Okay.
So yeah, so Dempster Mill, that they had this business that's operational. They had a lot of stocks, and that they had
Yep.
sold crappy part of the business and try to clean up things and unlock value. Um,
Yep.
it was selling for $18 when they started buying it, and they calculated book value to be 72, with $50 per share in the current assets, cash receivable inventory, less all liabilities. Dempster had earned good money in the past, but was only breaking even currently. The qualitative situation was on the negative side, a fairly tough industry and unimpressive management, but the figures were extremely attractive. The experience shows you can buy 100 situations like this and have perhaps 70 to 80 work out to reasonable profits in 1 to 3 years. Just why any particular one should do is hard to say at the time of purchase, but the group expectancy is favorable. Whether the impetus is from an improved industry situation, a takeover offer, a change in investor psychology, etc. We continue to buy the stock in small countries for 5 years. During most of this period, I was a director and was becoming constantly less impressed with the earnings prospects under existing management. However, I also became more familiar with the assets and operations, and my evaluation of the quantitative factors remained very favorable.
Mm-hmm.
By mid 1961, we owned about 30% of Dempster, and we had made several tender offers with poor results. But in August and September 1961, several large purchases of at $30 and a quarter per share, which with coupled with a subsequent tender offer at the same price, brought our holding to over 70%. Our purchases over the previous 5 years had been in the $16 to $25 range. On assuming control, we elevated the executive vice president to president to see what he would do unfettered by the previous policies. The results were unsatisfactory, and on April 23rd, 1962, we hired Harry Bottle as the president.
Mm-hmm.
Harry was the perfect man for the job. I recited his triumph before, and the accompanying comparative balance sheets speak louder than any words in demonstrating the re-employment of capital. So we have November 1961 here and July 1963 here, warning that this was unaudited by a third party at the time. Their cash went down. Marketable securities, there were none. But it looks like, $2 million
Mm-hmm.
more on total cash, obviously, and then securities went incredibly high, like $2 million.
Mm-hmm.
Accounts receivable, they reduced that. Inventory, they reduced that. Prepaid expenses, they reduced that. So current assets, kind of about the same or slightly less.
Mm-hmm.
Other assets, net plans, so PPE,
Yeah, a
operational
lot
kind
of
of
it.
things, like
Yeah,
they
got
got
sold
rid of
off.
a lot of waste.
Yep.
Notes payable, they don't have any. They paid off the things they had to pay. So their liabilities got reduced also by a lot.
Mm-hmm.
Total liabilities and net worth looks like they actually ended up having less net worth on paper,
Mm-hmm.
but for the stockholder, I mean, they had, because you can have a crappy equipment and you on paper say it's worth $1 million, but nobody's gonna pay you $1 million for it.
Mm-hmm.
So on book it looks like they had a lot more money before, but when they made the sales, like clearly they didn't, so they got
Yep.
$5 million.
Yep. Yep. Interesting. And remind me again, this is the company where he's going to make, with all the cash dividends that he gets, he's going to invest in other companies, right? Is that
Correct.
the
He's just
Yep.
turning into a
holding
vehicle like he
company?
did with
Okay.
Berkshire.
Okay.
So Harry took the inventory from over $4 million, much of it slow moving, to under $1 million, reducing carrying costs and obsolescence risk tremendously, correspondingly freeing up capital for marketable security purchases from which we gained over $400,000. Cut administrative and selling expenses from says cutting costs,
Mm.
cut factory overhead burden
Wow.
from per direct labor hour. So it's this cutting management, this is
Mm-hmm.
probably like middle management,
Mm-hmm.
overhead. Close the 5 branches operating unprofitably, leaving us with 3 good ones. Replace them with more productive distributors. Cleaned up headache at an auxiliary factory operation in Columbus, Nebraska. Eliminated job lines tying up considerable money, which could be used, and adjusted price for repair parts, thereby producing an estimated 200,000 additional profit with virtually no loss of volume. Man, he's like going all out.
He's
Basically, he took all of the
machete.
pipeline and he's
Yeah.
just, waving a magic wand saying optimize, optimize, sell,
Yep.
optimize, optimize, sell, sell,
Yep.
sell.
Yep.
Through these and many of the steps restored the earning capacity to a level commensurate with the capital employed.
Mm.
1963, the heavy corporate taxes we were facing, Harry surprised me with the speed with which he had earned up our tax loss carry forward, coupled with excess liquid funds within the corporate, compelled us to either in some way de-incorporate or sell the business.
Mm.
We set out to do either one or the other before the end of 1962. Deincorporating had many problems, but would have in fact doubled earnings for our partners and also eliminated the problem of corporate capital gains tax on dumpster securities. At virtually the last minute, after several earlier deals had fallen through at reasonably advanced stages, a sale of assets was made. Although there were, although there were a good many wrinkles to the sale, the net effect was to bring approximate book value.
Mm-hmm.
This, coupled with the gains we have in our portfolio market securities, gives us realization of about $80 per share. Dempster,
Oh,
now
wow.
named First Beatrice Corporation, we sold the name to the new company,
Mm-hmm.
is down to almost entirely cash and market securities now. On BPL's year-end audit, our First Beatrice holdings were valued at asset value with securities at market,
Mm-hmm.
less a 200,000 reserve for various contingencies.
Mm-hmm.
I might mention that we think the buyers will do very well with Dempster. They impress us as people of ability, and they have sound plans to expand the business and its profitability. We would have been quite happy to operate Dempster on an unincorporated basis, but we are also quite happy to sell it for a reasonable price. Our business is making excellent purchases,
Mm-hmm.
not making extraordinary sales.
Mm-hmm.
Harry works the same way I do. He likes big carrots. He's presently a limited partner of BPL, and the next belt tightening operation we have, he's our man.
Mm-hmm.
The Dempster saga points up several morals. Our business is one requiring patience. It has little in common with the portfolio of high-flying glamour stocks, and during periods of popularity for the latter, we may appear quite stodgy. It is to our advantage to have securities do nothing price-wise for months or perhaps years while we are buying them. Years while we are buying them. This points up the need to measure our results over an adequate period of time. We suggest 3 years as a minimum. We cannot talk about our current investment operations. Such an open mouth policy could never improve our results, and in some situations could seriously hurt us. For this reason, should anyone, including our partner, ask us whether we are interested in a security, we must plead the Fifth Amendment.
Mm-hmm.
Oh, what a beautiful, beautiful letter.
Yeah.
No, I got a lot more. I kind of just like that.
Yeah.
But that's where bulk of the lessons came from. His letters usually are kind of, hey, we
Vaguer.
killed it because we're
Yeah.
awesome, but we don't expect this in the future.
Mm-hmm.
And just and we made so much more money. We're so bulky, so growing, and just I don't know if we can do it again, but
Mm-hmm.
you know what? We can do it again.
Turns out we're awesome. Yeah, yeah. But it was pretty cool to find out some insights about how he thinks about with these workouts. I
Yeah, I
would
think that's
say,
incredible. I mean, it's like
yeah,
pure examples. I'm like, damn, this is
yeah,
what I want in my life.
yeah, yeah. He really delves super deep into it. Kind of like, maybe Munger's or Lilu's style, where he's like always invert, find out everything possible.
I mean, Leila basically tells you if you're gonna invest, you need to know more than the CEO about the
CEO,
business. I'm like,
right? Yeah,
damn boy,
yeah, yeah.
who do you think I am?
Lilu? Yeah, yeah. No, I hear you. It's incredible. Yeah, back inside to kind of what he did in 1964. Yeah. Let's see how long the 64 letter is. Let's see if, just the without the index
All
or
right.
the appendix. Ooh, he compares himself against the Dow. Okay, interesting. I'm sure he killed it. I'm excited to see that.
Taxes. I don't like nothing. Is there an appendix there?
No appendix.
The 1964.
Yeah. So there's two letters in 1964. Maybe we can go over those next time. Yeah.
I mean, it's yes. I agree.
Yeah.
Agree.
Oh,
How
it's gonna
it
be great.
go? Method of operations. Seems maybe there'll be something new there. Taxes. Well, that's long. The whole year is like.
Yeah. 1964 is.
Oh, there's no appendix. Okay.
Yeah.
All right.
Yeah.
Till next time.
Till next time.